Hello friends, welcome to Business Hologram YouTube channel. Today we will be focusing on the company Afcons Infrastructure Limited. So let's quickly get into the company overview. Afcons Infrastructure Limited is a leading Indian multinational engineering, property and construction company headquartered in Mumbai. As a flagship firm of the Shapoorji Pallonji Group, it is known for executing extreme engineering projects across several continents. The key leadership is Krishnamurthy Subramanian, who is the executive chairman of the company. Current stock price stands at rupees 329. Market capitalization is rupees 12,135 crores. It falls into the mid cap segment. If we look at the 52-week data, the highest price reached is at rupees 479 and the lowest price was at rupees 265. Let's see the core business verticals of the company. The company operates across 5 primary segments with a highly diversified order book. First is marine and industrial. Second is surface transport. Third is urban infrastructure. Fourth, hydro and underground. Fifth is oil and gas. Some of the iconic and notable projects include the Chenab Bridge, Atal Tunnel, Mumbai Ahmedabad HSR. International footprint includes significant presence in the Middle East and Africa, including the Tilamil Bridge in the Maldives and the Tema Patkan Railway in Ghana. Now let's look at the financial performance of the company for the last 4 quarters. As you can see in the screen, various financial parameters are given and its values for the last four quarters are also given. So the key takeaways from this data is revenue stagnation. Q3 FY26 marked the lowest revenue in 8 quarters, declining 7.33% year on year. This is attributed to slower project execution and the termination of a major 1.3 euro million international project earlier in the year. Next is margin strength. Despite falling revenue, operating margins hit a record 13.79% in Q3 FY26. Management has successfully focused on cost control and higher margin extreme engineering projects. Next point is profitability headwinds. The significant drop in net profit was primarily driven by a one-time 76.5 crore provision related to the implementation of the new labor code. Also, next point is order book visibility. The company maintains a healthy order book of 31,543 crores with a strong book-to-bill ratio of 2.5, ensuring steady revenue flow for the next 2 years. Now let's discuss the strategic focus of the company. First point that we are discussing is geographic diversification and European entry. Afcons is aggressively reducing its reliance on the Indian market to improve margins and diversify geopolitical risk. Its target include increase the international order book share to 30%, up from the current levels. The European expansion. The company recently secured L1 status for 3 major projects in Croatia. That is the lowest bidder status, marking its formal entry into the high margin European market. These projects are particularly attractive due to European funding and favorable payment terms. Next is core markets. Continued focus on South Asia, the Middle East and Africa, where it has established track record. So that was all about the geographic diversification and the European entry part. Next major point that we are considering is leadership in extreme engineering. Rather than competing for general civic work, Afcons is doubling down on complex high entry barrier projects where competition is lower and margins are higher. Some of the points under this category is specialized verticals. Urban infrastructure, metros, tunnels, etc. now make up roughly 54% of the order book. High-speed rail, HSR, positioned as a primary beneficiary of India's planned 7 new HSR corridors in the budget 2026. Afcons is leveraging its experience from the Mumbai-Ahmedabad undersea tunnel to bid for these multi-billion-dollar opportunities. Next point is equipment strategy. planned capex of 11 billion rupees for FY26, especially targeting advanced tunnel boring machines. In 2026 budgets new incentives for tunneling equipment further lower the cost of maintaining its specialized fleet. So that was all about the leadership in extreme engineering strategy. Our next major strategy in front of them is financial discipline and deleveraging. Post IPO, the company is shifting its focus from pure revenue growth to profitable execution. Some of the points to consider under this point is margin stabilization, aiming for sustainable EBITDA margins of 11% to 13% by prioritizing projects with a higher technical complexity. Debt reduction, utilizing IPO proceeds and improved cash flows to maintain a healthy net debt to equity ratio of 0.5, which provides the balance sheet strength needed to bid for mega projects. Next point is working capital optimization, actively working to resolve pending receivables to improve liquidity of half year HY26 and FY27. So these were the points under financial discipline and deleveraging strategy. Next major strategy is new frontiers, waterways and energy. That first point that we are considering is national waterways, exploring the government's push for 20 new national waterways, utilizing its marine and industrial expertise for jetty construction and dredging. Next point is green energy infrastructure, exploring balance of plant solutions and infrastructure for the emerging green hydrogen ecosystem in India. So these are the major strategic focus points of the company. Next, let's analyze the ownership structure of the company. As you can see in the screen, promoter group holds 50.17% of the shares, mutual funds 18.6%, foreign institutions 12.919%, retail and individual investors hold 16.69%, others, which include insurance, domestic institutional investors, corporate bodies, 2.35%. Key takeaways include the SP Group holds its majority stake through several key investment vehicles, which include the Goswami Infrastructure Private Limited 25% and Shapoorji Pallonji and Company Private Limited 15%. So the key holding is split between these two promoter groups. It is important to note that as of March 2026, roughly 60.13% of the promoter holding is pledged. This is a common strategic move within the SP Group to manage overall group liquidity and debt obligations. If we look at the other holding patterns, institutions collectively hold approximately 33% of the company. In that too, mutual fund surge, we can see domestic funds have been the most aggressive buyers recently. Key holders include the Quant Small Cap Fund, Nippon India Small Cap Fund, Invesco India Small Cap Fund. FII presents the global heavyweights like Goldman Sachs and the Prudential Assurance Company remain invested, providing global validation for the company's extreme engineering focus. Now let's move to the financial ratio analysis part. First, we will begin with the profitability ratios. As you can see in the screen, the EBITDA margin or the operating profit margin of the company stands at 13.3%, where the industry average is 10.5%. So it is at a superior position. Afcons leads the sector due to its specialization in high entry barrier extreme engineering projects. Next is net profit margin, which the value stands at 3.25%, where the industry average is 4.8%. So it's a laggard in this aspect. Heavy interest obligations at one time, labor provisions currently suppress the bottom line. And then next, if we look at the return on capital employed value, it stands at 22.8%, where the industry average is 18.5%. So it is also at a superior position. The company is exceptionally efficient at generating returns from the capital it deploys in complex infrastructure projects. If we look at the return on equity value, we can see the company value stands at 8.4 to 9.8 percentage, where the industry average is 13.6. So in this aspect also the company lags behind a bit. Now let's have a look at the leverage ratios of the company. First, we will look at the debt to equity ratio. It stands at 0.42, where the industry average is 0.65. So it is an improving trend, showing an improving trend down from 0.68 in 2024. Next parameter is interest coverage ratio. The company's value stands at 3.16, where the industry average is 2.8. It's also a stable value. It's also in the improving stage. Another thing, major thing that we should consider is that the IPO utilization. That is, Afcons went for IPO in late 2024. So a significant portion of the recent IPO proceeds were allocated to debt repayment, which has brought the debt to equity ratio down to 0.42, placing it well below the infrastructure industry average. Next, let's look at the core valuation ratios of the company. First one is P ratio. The current value stands at 27.35, where the industry average is 22. So it is trading at a slight premium value. It is trading roughly 24% above the industry average. Next, if we look at the price to book value ratio, the company's value stands at 2.35, where the industry average is 1.9. So it is also trading at a high value. Next, if we look at the price to sales ratio, the company's value stands at 0.95, where the industry average is 0.8. It is having a stable value in this parameter. Now let's do a SWOT analysis for the company. Firstly, we will get into the strengths of the company. First point under strengths is extreme engineering moat. Afcons is one of the few Indian firms capable of executing high complexity projects like the world's tallest rail bridge and deep sea tunnels. Next point is diversified order book. A robust 35,310 crore order books spanning metros, hydro, marine, and oil and gas, providing revenue visibility for the next 3 years. Next point is operational efficiency. Record high operating margins, outperforming the industry average. Next strength point is strategic equipment base. Ownership of a specialized fleet of heavy machinery reduces dependence on third-party rentals and speeds up execution. So these are the strength points of the company. Now let's see some points under the weaknesses of the company. First point that we consider is promoter pledge risk. High level of promoter share pledging, over 50% by the SP group, remains a point of concern for retail and institutional investors. Next point is subdued bottom line. Despite high operational profits, the net profit margin is pressurized by high finance cost and one-time labor provisions. Next point is low revenue growth. 5-year sales growth has been nearly flat, signaling challenges in scaling the business despite having a large order book. Next point is working capital stress. Significant receivables have historically strained liquidity. Next, we will look at the opportunities in front of the company. First point is European expansion. Successful entry into the Croatia market with L1 status on major projects opens a high margin internationally funded revenue stream. Next point is budget 2026 tailwinds. India's focus on high speed rail and new national waterways aligns perfectly with Afcons' core technical strengths. Next point is deleveraging. Using IPO proceeds to reduce debt could significantly boost net profit by lowering interest expenses. Next point is targeting 30% international orders. Increasing global orders provides a natural hedge against domestic slowdowns and political shifts in India. Now let's look at some of the probable threats in front of the company. First point that we consider is execution delays. As a firm focusing on complex projects, any delay in specialized equipment or technical hurdles can lead to massive cost overruns. Next point is interest rate volatility. With an interest coverage ratio hovering around 1.5 to 3.1, the company remains sensitive to fluctuations in global and domestic lending rates. Next point is geopolitical risk. Significant exposure to Africa and Middle East makes the company vulnerable to regional instabilities. Next point is technical bearishness. The stock has recently hit all-time lows, which may lead to further stock-specific sell-offs regardless of fundamental improvements. So friends, that's all about the company and stock analysis of Afcons Infrastructure Limited. If you found the video useful, please like, subscribe, share, comment and support. Thank you.